Welcome back. Today, we're putting on our analyst hats to dissect the 2026 financial anatomy and profit growth potential of Vietnam's petroleum giant, PLX. We're going to take those complex financial forecasts and shifting macroeconomic variables and translate them into a clear, actionable investment narrative for you. If you've been following the energy sector, you know PLX sits right at this crazy intersection of government policy, global oil markets, and domestic economic recovery. So let's dive right in and see exactly how all of this is shaping their bottom line.
49,600 VND. That is the exact end of 2026 target price analysts have pinned on PLX, and it represents a massive 28.3% total return potential. So how exactly did professional institutions arrive at this precise valuation in such a volatile global market? And why the strong buy rating? What's the financial engine actually driving this? Well, let's figure it out together.
To get there, we'll walk through 5 key areas today. First, growth engines. Second, pricing and margins. Third, oil volatility and geopolitics. Fourth, risks and pressures. And finally, valuation and returns.
All right, starting with Section 1, growth engines. We're looking at a projected 8% surge in demand for PLX in 2026. Now, this isn't just blind optimism. It's mechanically linked to Vietnam's broader economic recovery, which is expected to boost national fuel demand by around 6 to 8%. On top of that, we're seeing strong projected growth in high-margin aviation fuel, while diesel, which makes up over half of all consumption, is keeping industrial activity moving. But here's the real kicker: PLX's proactive supply chain management. While competitors were literally struggling with supply disruptions, PLX aggressively surged their imports by 58% early in the year. They bought low, built massive inventory, and snatched up significant market share. Just brilliant execution. Then there's a huge policy dividend heading their way: the nationwide rollout of E10 gasoline. This biofuel blend is slated for nationwide implementation by mid-2026. Because PLX has already sunk the capital into upgrading their infrastructure and ethanol blending networks, they have a massive, unique market share advantage. They are ready to roll, while smaller distributors without the capital to pivot quickly are just going to sit there and bleed market share. This is an absolute tailwind for PLX's future revenue. Let's move on to Section 2, pricing and margins. This shift from the old pricing mechanism to the new draft is a literal game changer. Under the old system, PLX's pricing constantly lagged behind global oil fluctuations. If crude spiked, they couldn't adjust retail prices fast enough, leading to delayed adjustments and, frankly, painful enterprise losses. But this new draft mechanism, it pivots to actual market-based pricing. It finally allows enterprises to reflect their true transport costs and exchange rates directly in retail prices. This acts like a massive shield for their gross margins, completely fixing that painful lag effect of the past. To see how sensitive profits actually are, let's look at the gross margin trends between 2025 and 2026. In 2025, actual margins set at a healthy 5.9%. Looking ahead to 2026, if we had scenario 1, where global oil stabilizes around $80 a barrel, that new pricing mechanism helps expand margins to 6.2%. But look at scenario 2. If oil spikes to $95, margins actually compress down to 4.5%. Why? Because even with better pricing mechanisms, extreme import costs still fundamentally squeeze the final profit potential. Which brings us perfectly into Section 3, oil volatility and geopolitics. To establish our baseline here, we're relying on the ACBS April 2026 update report. This gives us a really objective look at how geopolitical events, halfway across the world, cascade directly into PLX's financial realities in Vietnam. A perfect example of a short-term shock is the Hormuz Strait bottleneck from March 2026. Escalating tensions literally choked off 20% of global crude supply almost overnight. This mechanically spiked Brent crude to $119 a barrel. For a massive importer like PLX, this kind of sudden raw material cost spike is the ultimate stress test. Analysts break the fallout into 2 potential scenarios. In scenario 1, tensions cool down. Global supply chains normalize, and Brent crude stabilizes around a healthy $80 a barrel. In this environment, PLX thrives. They can optimize retail and operational costs, and stable fuel prices stimulate domestic travel and industrial production. The end result? Their gross margin expands right up to that projected 6.2%. Conversely, scenario 2 assumes tensions escalate. Brent crude stays elevated, hovering between $95 and $110.
Now, initially, PLX actually gets a short-term windfall because they're selling off that cheap inventory they aggressively imported earlier. But don't be fooled. That's just an inventory illusion. Long-term, sustained high oil prices are incredibly dangerous for profitability. Transport costs soar, consumer demand gets destroyed, and as you can see, gross margins compress sharply to 4.5%. Let's transition to Section 4, Risks and Pressures.
We need to unpack this profit pressure pathway because it's a fascinating dynamic. Step 1, global crude oil prices surge rapidly due to an external shock. Step 2, this immediately causes domestic inflation pressures to rise sharply. Step 3, and this is the unique part, to fulfill its duties as a state-owned enterprise and protect the broader economy, PLX caps retail prices. They refuse to pass the full cost on to consumers. Which leads to Step 4. PLX's profit margins are deliberately sacrificed and compressed. It's a noble macroeconomic shield, but as an investor, it's absolutely a microfinancial risk point you have to monitor closely. And looking beyond 2026, we have to weigh these near-term headwinds against long-term threats. Yes, geopolitical shocks and raw material cost spikes squeeze margins right now, but the undeniable structural threat is the energy transition to electric vehicles. Analysts point out that while growth is strong now, between 2026 and 2030, as EVs structurally reduce traditional fuel demand, overall sales volume growth could slow down to around 7%.
Finally, let's wrap up with Section 5, Valuation and Returns. Pulling all these macroeconomic and financial threads together, let's look at the ultimate 2026 models. Under the optimal baseline scenario with margin expansion and 8% volume growth, analysts project PLX's net profit to hit a staggering 3,688 billion VND. Using discounted cash flow models, which basically translate future expected earnings into today's value, analysts convert this data directly into that 49,600 VND target price we mentioned at the start, earning it a solid buy rating. Breaking down that total investment return potential, the numbers are highly attractive. From the current trading price, you're looking at a massive 25.5% capital appreciation upside. But do not ignore the dividend. There's an expected 2.8% dividend yield. Combine those, and you get an impressive 28.3% total return. In a choppy market, that reliable dividend acts as a fantastic buffer for investors. So, to sum it up for retail investors, the core allocation indicators are crystal clear. The consensus target price is 49,600 VND with a buy rating. But the real strength here is financial stability. PLX is sitting on a massive cash reserve of 28.53 trillion VND, and they boast a reliable history of paying 10 to 15% annual cash dividends. They are the prime beneficiary of the new market-based pricing mechanisms, and their sheer scale makes them a highly defensive asset in a volatile geopolitical landscape.
Which brings us to our final thought. We've seen the 8% demand drivers, the defensive margin mechanisms, and the geopolitical stress tests. Amidst the long-term energy transition and near-term geopolitical storms, does PLX have the resilience to be the core defensive asset in your 2026 portfolio? That's the question you have to answer for yourself. Thanks so much for joining us for this explainer. Keep learning, stay sharp, and we'll catch you next time.